Welcome to the Sojourn Wealth Management Podcast. This is Andrew Kraft. I'm here with Jeff Bronner and Corey Akins doing another episode on our investment basics. This time we're touching on alternatives. So by definition, something different than what we've normally touched on before. Hey guys, thanks for being here. First of all, are y'all ready for Christmas? Not to date the episode or anything, but
yes. Paige and I keep commenting on how astounded we are that it's December 23rd right now. So
really dating the episode. 10:33 a.m. to be exact. I feel more prepared this year than I have maybe ever, actually.
Wow.
Gifts are wrapped under the tree.
Well, Jeff and I are excited to see what those are.
Yeah.
I'm sure you are.
We'll be over 7 a.m. sharp in our footy PJs ready to open up presents at your house.
That would be odd because you both have families.
They're coming too, right?
The more the merrier. Come on.
Nice. Yeah. What a wonderful time of the year.
Yeah. It's the best.
All right. So let's dive into it. First, kind of general question. What are alternatives? What's kind of a general definition of that?
Well, like you said at the top, Andrew, alternatives are something different. When we talk about our alternative investments, we're talking about something that's an alternate to the kind of traditional asset classes of stocks, bonds, cash. So very broad definition there, a lot of room within that investment category for all types of different investments. So we'll dive into more of those. But that's kind of generally, when somebody says alternatives, they're talking about something different than the traditional stocks, bonds, and cash portfolio.
So as people look into that, why is that something that is added to a portfolio? Like why do people look at alternatives for investing?
Well, they provide greater diversification within your portfolio. Mm-hmm. So stocks, bonds, cash, we generally know what they're going to do. Alternatives provide a hedge against kind of those traditional asset classes that can have higher returns in some cases and just, again, add more diversity into the portfolio holdings.
So like in the past, stocks and bonds were kind of seen as the zig and the zag. Mm-hmm. And so you're saying this is just a third kind of way to...
This is a zog.
Yes, very good.
So, yeah. I mean, it's an important piece because especially as more things come out too, right? So there are generally more alternative investments available now than there were 40 years ago. And so it's just a way to broaden the holdings that you have and ultimately create something that from a recommendation standpoint is unique to your situation that fits the need.
Yeah. And I think part of the reason for the increase in popularity, just recent market history, the kind of lag of the S&P in the 2000s and things like that, people are looking for more opportunities to kind of supplement their portfolios. You see the advent with alternatives becoming more accessible of portfolios that aren't just 60-40, but something like a 50-30-20, where you have stocks, bonds, and alternatives being another component of that to, again, add that extra layer of diversification.
And I think, too, like what we've seen as a practice is when you look at the S&P 500, the performance of the S&P 500 is weighted very heavily towards a handful of companies. Alternatives give you, again, just the ability to maybe not be so weighted even in a regular portfolio like stocks and bonds where there can be a ton of concentration. Yeah. So it gives you that ability to not be, so concentrated even in a already diverse portfolio.
Right. And part of that is the correlation. Alternatives have different types of correlation to what a stock or a bond would do. And so it kind of, when you were saying zig, zag, and zog, it provides something that's doing something differently than what the other typical asset classes
Trademark pending on that.
So one goal, increase that diversification. In other words, to kind of reduce the amplitude of the wave or the roller coaster ride that the portfolio is on. And then you mentioned some, different kind of returns, pursuing more returns. So kind of just diving a little bit deeper into alternatives, what are some kind of specific types that are used in the investment portfolios?
There's a handful of most common types, but again, it's a very broad. There's a lot that can fit into the definition of alternatives. Probably the most accessible one, or the most familiar one, I should say, would be real estate. So if you were to just take a lump of cash and buy an investment property, that would be an alternative investment. And just depending on what your strategy is there, whether it be an income strategy or a capital appreciation strategy, that could be either one of those. But, this is something where you have your investment portfolio and then you have this thing over here that's different. It's distinct. So that would be an easy way for somebody, if they're thinking alternatives, that's a good start, is real estate.
And even within real estate too, you can do it different ways, right? So like you've got things like REITs, real estate investment trusts, direct ownership. Like there's even diversity in the way that you can own real estate.
Right.
Right. So it just continues to kind of drill down.
And that gets back to the trend you were talking about. Investment companies have noticed the desire for more diversification in alternatives in things like real estate. And so they've not invented, but, over the last however many years have developed these different funds that people can get into that expose them to real estate assets.
Yeah, often you see those REITs as the kind of sole alternative. And so if you look at a client statement and there's a pie chart.
Like every 401k.
one color has stocks, one color is bonds, and then you get a little sliver of REITs.
Yeah.
And so now we know what those are. It's real estate alternative investment.
Right. And for the listener, real estate investment trusts is what REIT, REIT means.
That's right.
Another common type would be things like private markets. So this is something that has been available for, this might even be the oldest type of investment. You just take a lump sum and you invest it into a private company. Nowadays, it's typically a very high entry point. You have to have a lot of money, like $1 million, $5 million, $10 million in some instances, to have access to this type of alternative. It's not publicly traded. It's a private deal, and you have to have some sort of kind of broker within that. So that's not an accessible one, but that's another opportunity. And private markets can have things like infrastructure type of plans. You see like nuclear power plants, water treatment facilities, data centers. Those are all examples of what could be a private market
and it's
investment.
It's not traditional investing typically either, right? So a lot of times it's locked up for a period of time. There's higher fees typically. So it comes with its own set of, particular regulation from the way that they do it. But the reason is because a lot of times you're looking for higher returns.
Right.
And that's, kind of the trade-off there.
Right. And we'll get more into, similar with real estate investment trust, there's different funds that have been created to provide more accessibility to somebody, with like an $1,000 minimum. You can get into a mutual fund not a mutual fund, an interval fund that will give you access to that. And we'll talk more about that when we get into some of the characteristics of these investments later on. Another category that, these been around for a while is collectibles, art, coins, trading cards,
wine,
certain types of, anything that would have value as a collectible.
It's my favorite liquid asset.
The favorite liquid asset.
Ironically, collectibles are usually illiquid because you have to be very, very particular in the market that you're selling. Not if you have a very high dollar bottle of wine, you might have to find a particular buyer to sell that to. So
another thing is that they're typically like, that's a very subjective market, right?
Yes.
So like when you're thinking about the value of art, the value of wine, like, there's not really the market kind of coming to, like, there's some of that, but you're also having to deal with somebody who's got a 1938 bottle of whatever, and they've kind of priced it in their head, right? And so it's a very subjective valuation process.
So I think it's so different from like traditional stocks. A lot of times that present value of the stock is based on what you anticipate the future earnings and profit to be. So as you hold the stock, you get this income.
Right.
Well, if you hold a Rembrandt or a bottle of wine, you're just hoping that will appreciate in value later by someone else. So I think that's what you mean by it's very subjective. You can't really kind of put a price on, because there's no income being generated.
Yeah.
It doesn't have fundamentals is what it's referred to. You can look at a business, you can look at a stock, you can say these are the data points that would contribute to the valuation that I'm selling this for. Whereas with a 100-year-old bottle of scotch, it's going to depend on what the person who's buying it, the price that they put on it. So
yeah,
one of the most the hot topics in alternatives right now are digital assets. So that'd be cryptocurrencies. Is a big one. Bitcoin, Ethereum, all of those different ones. And then you have things like NFTs and all these different types of cryptocurrencies and digital assets that have come about in the last 20 years or so. There is a lot to cover on this, but I think it kind of goes to a similar concern that you're putting forward with collectibles, the subjective pricing, the volatility of it.
Yeah.
Is a huge characteristic of a digital asset.
I think too, it's probably the most common one that when people think of alternative investments, maybe they don't think about it in that category, but it's the one that the guy who is constantly talking about his investments is talking about, right? Oh, my Bitcoin or my, Ethereum or whatever it is, kind of always checking it.
Mm-hmm.
I remember 10 plus years ago when Bitcoin was just kind of really becoming mainstream, people were like, oh, look at my Bitcoin, look at my Bitcoin. And I didn't know anything about it then, right? And it was so brand new, but it was just it's probably the most popular one or become the most mainstream from just a kind of investor perspective in the last several years.
When I was in college, I was sitting next to a guy in a religious studies class or something like that. And I remember one day in class, he just turns to me and he did not frequently attend class.
Okay.
And just one day, we were just talking about something, and he just brings up kind of unsolicited the fact that he owns hundreds of thousands of dollars in Bitcoin. And at that point, I was like, wow, that's pretty cool.
Yeah.
What's Bitcoin?
What's Bitcoin? What is that?
Yeah. And so who knows at that point what the pricing was or how truthful that claim was and all those things. But you hear that kind of story.
Yes.
People will bring it up, and there's all sorts of fascination with it because it's very trendy right now.
I think it's the one that has been it's been brought to market where you see, in our day and age, more people are participating in it.
Right.
Maybe not Bitcoin now because it's so it's valued so highly, but other things like Dogecoin or Ethereum or whatever it is. And I think it does have certainly a place, but
yes.
I guess just a side note is don't get caught up necessarily in the.
And that's the big thing is when I say trendy, I don't mean to dismiss, because there's going to be a presence of cryptocurrency in some form or fashion, but there's just so much uncertainty and volatility in it now. There's regulative risk. There's all sorts of converstions about how it's going to be regulated. So we want to approach that with an open mind, but with a good level of cautious, how do we incorporate this? And again, there's been a lot of companies that have developed investment strategies that, I was talking to a fund manager who they hedge Bitcoin with gold.
Yeah.
So there's the upside, opportunity with Bitcoin, but there is, some kind of downside protection with gold. And, there's some additional components to that, but, it's a conversation that's happening and developing, and it's just something we need to be tracking.
Yeah.
And there is, I think a value in the, blockchain technology, if I'm using that phrase right, and these different types of digital currencies and things, but those are relatively newer types of alternatives. And so let's turn to some of the more historically known alternatives. What are some of those that might be familiar to our listeners?
Well, the last category we're going to get into is commodities. So probably one of the most cherished and valued and frequently utilized on holidays like Valentine's Day and Christmas would be gold. So commodities would capture precious metals. And
I think Burl Ives would say silver and gold.
Silver and gold.
Silver and gold. Some copper in there. Iron,
That also includes things like agricultural contracts and things of that nature. Beans, soybeans.
Futures contracts, right?
Yeah. That's right.
But I think if you kind of break it down into those four things, like you said, the precious metals, and then I think silver kind of straddles both precious and then industrial metals, right? It's used a lot. the agriculture, cotton, pork bellies.
Yeah, right.
Which, whether it's, big ham down
Who doesn't
from
want to
Monroe
invest
County
in
or whatever.
I love it.
And then, energy, that kind of thing. So there's a lot of different types of
like oil thing, right? So that's probably the one that gets the most, or at least in the last 20 years, has been talked about in the mainstream the most because
Texas
it's had
crude.
Yeah, it's had political implications. But those are all kind of falling in that commodities umbrella.
Yeah.
I mean, who doesn't want to invest in pork?
Didn't you just pick up a big ham yesterday in Madisonville?
Yep. Shout out to we're not sponsored by Benton's Ham, but
cut the check.
I certainly encourage the utilization of their bacon.
That's awesome.
So do y'all think differently about those kind of, because
it's probably my favorite of the alternatives.
Yeah,
because if you think about just gold, right? Like everybody kind of has a general understanding of gold and why it's valuable and the history of our world. Gold has been what has been valued the most, right? And so I think there's just kind of a cadence that is familiar when you speak of precious metals, and I think that's within that category of commodities. That's why I like it so much.
And what's interesting about gold is it's kind of like the oldest currency, right? It's been used for so long as a measure of value, a measure of a method of trading. So there's kind of a historical precedence that kind of supports its legitimacy in an investment portfolio.
Yeah.
So we are no Williams Jennings Bryans around here, I guess. So these types of alternatives, obviously, I'll mention the great upside, lower lower volatility with the diversification, but comes with some inherent risks. So let's unpack those a little bit.
The first big risk would be liquidity. Corey touched on this with the collectibles. There's a particular market where you need to sell, certain collectibles. You have to find the right buyer. And probably the easiest way to illustrate this would be with real estate. Right now, we're currently in what would be categorized as a buyer's market. In the real estate market, houses are sitting on the market longer. Sellers are having a harder time liquidating that asset. And the same could apply for multiple different alternative types. So that would be a big consideration whenever we're kind of plugging an alternative into a portfolio is, does this expose us to unnecessary or undesirable liquidity risk? Are we going to need to access these funds within a particular time period, schedule, what have you? And if so, an alternative investment might not be the most suitable recommendation in that scenario.
Yeah. I think, go ahead, Andrew, sorry.
I think it's interesting also how other aspects of the economy can affect the risks or volatility of alternatives. So real estate, for example, obviously affected by interest rates, mortgages, lending rates, which is, connected to what the Fed said. So as interest rates go up and down, then that affects the liquidity potentially of that alternative. Or, inflation, the Fed's part of their dual mandate is to have an inflation kind of goal. Well, that affects some of the other commodities we talked about, like precious metals. So it's just kind of interesting how other parts of the economy will kind of affect the value of those.
Yeah. And that leads to the second point, which is volatility, right? So those factors lead to greater volatility or less volatility, right? So if you think about kind of what we were talking about earlier, the general 60-40 portfolio stocks and bonds, a lot of times these alternative investments are doing the opposite of what the market is doing. And so that can create a piece of, greater volatility, like the market's up and maybe our precious metals are not doing so well or whatever it is. So that piece of the puzzle, I think, that is something that obviously has to be explained and understood before you ever invest in alternatives.
Right.
And it's also the reason why I think it should be packaged kind of as an investment whole. Like you should never kind of silo out your alternative investments from the overall kind of portfolio.
Right. And I think that's one of the big reasons its volatility is helpful. It can be helpful because it can be volatile at different times in other asset classes, which is why it's a good diversifier and can help to really level out your portfolio. But it's also why we're cautious about things like cryptocurrencies that are incredibly volatile, and there's a lot of kind of newness with that.
And there's a lot of unknowns in alternatives, right? And so you make better decisions when you have more information. The reason that the prices in the S&P 500 are what they are is because of data. There's whole laws that have been written and commissions that have been put together for what? To
transparency.
Yeah, to create transparency and to deter like insider trading or having information that is not available to the public.
Right.
And so that's why it's the kind of cautious optimism with alternatives. But you've got to know kind of going in that a lot of times the information is not going to be readily accessible in that sense. So
it reminds me what I think it was Warren Buffett in the late 90s, where a lot of his investments, Berkshire Hathaway did not include like Pets.com, for example, or Quest or whatever, these tech companies, because they were so new that the data wasn't really available. It was kind of unknown. And so he was kind of asked like, well, I don't understand it, so I'm not going to invest in it. And, his portfolio, from what I understand, was really lagging, but then it came back, and it kind of reminds me, or makes you think of the situation that you just put forth, Corey, where the S&P or the stock, broader market might be up, but your precious metals or alternatives might be down. Well, the idea is to then insulate it, because ultimately the stocks will go the other way, and hopefully that will kind of come back up. And so it's kind of like having an emergency fund of your investments in a sense, to kind of protect against the kind of wild swings and take advantage when parts of the market are doing things differently.
In what's interesting about alternatives is it can kind of do both. You can have more aggressive alternatives, and you can have less aggressive alternatives. So depending on where you are on the risk spectrum might help to clarify what type of alternative would be more appropriate for your particular portfolio.
So just like with stocks, there could be big known companies that are less aggressive than kind of smaller new companies. Same thing with alts.
Right. Exactly right. If you're a very conservative investor, you might be very cautious about investing in Bitcoin because it's so volatile. You might like gold better because it has that kind of historical precedence and the fundamental of a hard, tangible asset connected to it.
Or like REITs that we talked about earlier. Often, those are diversified among a bunch of different apartment houses or whatever, but they also produce interest if it's rental income and more liquid because it's traded. So
Right.
So we talked about the benefits, the returns, talked about some of the risks. What's just kind of maybe like a note of caution that we might want to kind of share with our listeners?
Well, I'll just reiterate something that Corey had said earlier, which is that we shouldn't silo this investment and kind of consider it something distinct, but that rather it's part of an overall portfolio, and it's not a replacement. You're not just saying, hey, we're going to forego stocks and bonds and just invest in alternatives, but that it's something to be incorporated into to help diversify and supplement, that traditional asset allocation model. Some people will approach alternatives with a sort of almost like an excited fixation with this is where I need to go with my money. This is where it needs to be. And that's just kind of contrary to our overall investment philosophy, which is more strategically based. But alternatives have a good spot in that strategy.
Yeah, what typically happens is it becomes so magnified that when folks talk about their investments, it's either real estate or gold or whatever, and it creates this it creates the opposite of what we want, right? So if you have so much money tied to that one alternative or that one investment, well, what happens when it goes down? Then most people get out, and that's the opposite of what we want to do, right? And so if you can pair it with your overall portfolio based on your goals and objectives, then you can ride some of those waves of downturn or volatility. And so I would just say that, I see it a lot, or I've heard it a lot, where people kind of get fixated on this cool investment,
Yeah.
and you kind of lose sight of the bigger picture.
Right.
And I don't think you can do that. I don't think that's wise or prudent.
Yeah. A helpful question that we'll ask clients when alternatives are brought up, or a particular alternative is brought up, is how does this fit into the overall strategy? Or do you think that this is a trend? Does this make sense for your particular goals? And if so, let's figure out a way to incorporate this and really make it work with your investment strategy. Otherwise, we might be susceptible to that kind of excitement that comes with, oh, this investment just went up a lot, or I've heard a lot of exciting things at work or something about this particular thing. We just need to be careful not to kind of re-strategize based off of the exciting things we're hearing about on the news or on social media.
A telltale sign of somebody who's chased trends in the past is this phrase: if I had just held X, Y, or Z stock, I'd have now. Right? That's trend chasing.
Yeah.
And it's not even like I've heard it a lot with Bitcoin. If I had just held Bitcoin at past 2010, I'd be X, Y, and Z, rich now. And so that is trend chasing. That's not putting it in as a strategy of your overall investment philosophy. That's just trying to chase a buck. And that's not wise.
So we mentioned to our clients that a small piece of that investment pie, might have some alternatives as part of a strategy of diversification and pursuing, additional gains. Have y'all just found, as y'all meet with clients, that people have brought up Bitcoin or gold? Because those are a lot of things in the news. I think, was it yesterday, or 2 days ago, gold hit like another new high. So is that kind of coming up of its own, just kind of conversation, or is it usually always in response to us mentioning it?
I think it's funny. There's kind of two types of clients. There's the client that'll bring up gold, or there's the client that'll bring up Bitcoin. And that's kind of it's almost like a benchmark for like, where is their mind at? What's the information that they're consuming? And it's a helpful insight. And I think that a lot of clients will ask about it. There's been few conversations where it's kind of emphatic about it, but they just want to know because people are talking a lot about it. And I think it's important that we're able to provide some insight into that as well.
I think more people bring up gold than they do cryptocurrency with me.
Yeah.
But I think it's also, there's a lot of factors that lend itself to that. I think a lot of people see gold as this kind of safety net.
The store of value.
Yeah,
right.
That's exactly right. And so that's why I think it gets brought up a lot.
Yeah, I think the few times folks have brought up crypto, it's usually asking me if I, invest in it, or we do as a firm, and then they generally say, "Good, I don't want to have any of that stuff."
I think people I think people see the volatility, and it's scary.
Yeah.
If you're talking about your life savings, you want to be careful about how you navigate that.
Absolutely.
Well, guys, it's been good talking about alternatives. A little different discussion than we normally have, by definition. Any kind of last thoughts that y'all want to share?
I just appreciate the conversation, and as we go into Christmas, I hope you all have a wonderful and merry Christmas.
And as always, if our listeners have any questions, feel free to reach out. Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. Securities offered through Kestra Investment Services, LLC, Kestra INS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth Management, LLC.